How about your pay raises? Are they going to increase? No. If the Fed gets what they want, your pay raises will get frozen during this period of time. And in fact, may go down. Today we're going to talk about the increase of rates by the Federal Reserve the other day. The Federal Reserve is really in control of the economy ever since it was created in 1916. Now, in 1916, of course, they had a problem with basically farmers that couldn't get enough capital after a bad harvest to continue planting the next year. So it was causing food shortages and challenges in the economy. So the solution that Eccles had was to create a fiat currency that could put local banks in the areas where people needed loans in order to increase their ability to have access to capital in order to continue growth. That was the general idea of creating the Federal Reserve in the first place. So the Federal Reserve has existed since 1916. Now, today, the federal funds rate is at 1.75, and technically they tell it to you as 1.5 to 1.75. That is a raise of 0.75% since last month. Now, what's interesting about that is that they've done it in 2 consecutive months. They raised it 0.5 a month ago, and then in January they had raised it also 0.25. So where it was 1% before the end of January, it's now gone up 0.25, then 0.5, and now it's at another 0.75. So we are galloping forward in the raise of interest rates. So let's look at a little bit of history, because I want to show you what it really is going to point to. Here's a chart with the GDP, or the gross domestic product, since 1970. 1975, starting in 74 through this time, there was a recession, and we have a mini recession here that looks like it lasted a couple quarters. And then we have a fairly hefty recession here. Now, when they talk about inflation being higher than it was in 40 years, what we're talking about is this time frame right here, where they were combating inflation. And the Federal Reserve deliberately wants to slow the economy. Well, when it deliberately slows the economy, what does that mean? It deliberately sends the economy into a recession. It wants it to back up and stop growing so much. Now, when they talk in the news media about a hard landing, well, a hard landing is basically what we experienced in 1982. And they're trying to prevent the hard landing, but at the same time slow the economy. I can pretty well guarantee you at this point that the next quarter's GDP is going to be lower than the previous quarter. And that comes out starting in July. Okay, they'll compute all the numbers for the March through April through June timeframe, and that number will come out in July. It went down. If we look at this chart, it went down in the previous quarter here, down 1.5%. And the definition of a recession is 2 consecutive quarters of slowdown. Okay, so if GDP is less than it was last quarter, then you'll see a negative number here, and that will mean that we're technically in a recession. And what they want to prevent is a long recession. This one lasted 2 years. Now, let me share a little bit of history during that time. Paul Volcker was the Federal Reserve Chairman at the time, and he took office in July, middle of the year, 1979. He served until 1987. So the inflation rates at that point had peaked. In March of 1980, the inflation rate peaked at 14.8%. We're currently at 8.3%. Okay? So we're 6 points away from the peak inflation rate in 1980. It fell to 3% in 1983. So what the Federal Reserve did then was effective. But listen to what they did. He raised the federal funds rate, which today is at 1.75. He raised it to 11.2% in 1979. And by the end of 1981, that interest rate was 21.5%. Now, 21.5% means that you and I, when we pay mortgages, we're going to pay that much or more, okay? Mortgages were almost non-existent during this period of time. Now, my wife and I got married in 1980. We bought 2 houses during this period of time. The first house we were able to get from a bank, and we felt we were lucky at 13%. Wow, that was great. Perspectives have changed a lot since then. People have grown to expect the idea of a 3% mortgage today, and ours was a full 10% higher, okay? Now, our second house that we bought during that period of time, the couple, in order to get the house sold, carried the mortgage themselves. In other words, they became the mortgage company. They became the bank. So what we did is we paid a down payment, which went straight to them. They kept their current mortgage, and they took payments from us at an interest rate that was better than what we could have got at the bank. Okay? So in order to do that, we had to get some preferential treatment by the seller in order to keep real estate moving. Okay. Now, one thing that also happened during that particular inflation is that the unemployment rate rose to 10%. So 1 in every 10 people was out of work during that time that was actively looking for work. Now, there's a lot of discouraged workers that fall out of that number simply because they stop looking for work. So because they're not actively taking unemployment checks, they don't get counted in the statistic. So likely more people were out of work that wanted work back then, but they had already gone past their benefits, which weren't as long as they are today, or they had just stopped working and forgotten about collecting benefits, because back then, if you didn't prove that you were looking for a job, your benefits stopped, okay? So that's a little bit of a history lesson. Now, let's look at a few of the statements by the Federal Reserve in this particular article by Money Watch. The last time we saw a single raise of 0.75 was clear back in 1994. So the range is 1.5 to 1.75, as I said. I said, recent signals that inflation is accelerating spurred policymakers to move more aggressively to slow economic growth in a bid to tame prices. Now, how do they do that? Prices go down when there's less demand for products. That's just regular supply and demand economics. Now, watch a few statements that are made in this. It tries to tamp demand for labor. Cooling the job market would reduce wage growth. How about your pay raises? Are they going to increase? No. If the Fed gets what they want, your pay raises will get frozen during this period of time. And in fact, may go down. Offers for new jobs might be able to offer you less than what they would have offered last year or the year before. So the whole idea is they don't want as much wage growth because they don't want as much money in your pocket, because if you have money in your pocket, you're going to spend it, and they want to reduce spending. So you see the connection there. Okay, now the Fed rapidly shifted gears this year from propping up the economy during the pandemic to trying to choke off a surge in consumer prices, which have been rising at the fastest rate since 1980s. Well, remember in my last video that we've had prices rising at 4% or more ever since February of last year. So, why are they getting all concerned about it now, except for the fact that it's gone sharply higher, and we've seen gas at the pump go horribly high. So sharply higher borrowing costs could snuff out economic growth and cause a hard landing or even a serious recession. It's going to at least cause a mild recession, if not. If they have a hard landing, they're going to have a recession like what we experienced in the 1980s, where we had inflation up at close to this level already. So we'll have to watch for future indicators and see what happens. So he says, but the steepest inflation since 1981 is hitting households hard and causing consumer spending to shrink. So consumer spending is already getting tamped down. Now the interest rates are going to make it even worse. Now, the whole part of this too is that the housing market is dramatically affected by this, because your mortgage rates are going to go up. And the more your mortgage rates go up, the less you can afford in a house, and the less sellers can get increases on their houses. So those increases are going to get tamped down as well. The housing market is going to cool, if not crash. And during that period of time, you're going to see either a very dramatic slowdown or leveling off of prices, or if it crashes, you'll start seeing prices go actually downward as people just can't afford the high prices that we've seen lately. So, hope you've enjoyed what you have here, what I've shown you here. Please subscribe so we can keep growing the channel, and I hope to see you again later. Thanks.